Public market investor ValueQuest Investment Advisors has entered the private equity space with their new fund. Here are my conversation with Ravi Dharamshi as well as Varun Goenka of ValueQuest Investment Advisors. Gentlemen, thanks so much for taking time out on the Startup Central. Ravi, we're so accustomed to having you on the show to discuss just your market outlook. So now it's pretty interesting that you guys are looking quite closely at the private equity space. This obviously means that you're sensing a lot of opportunity here. Tell us more.
Yeah, no, absolutely. I think there is an opportunity, but at the same time, our thinking is not tactical. We are thinking longer term. We are thinking more of, moving adjacent to what our skill set already are. It's not a diversification for us. We are just adding to our capabilities. We are just moving one step back from the public markets to late stage equity. We are not going towards early stage venture seed, those kind of areas.
Okay. So, Varun, walk us through the outlook in terms of what the target corpus is, what the plan is for the AIF.
So we're looking at approximately $100 million of initial corpus. Ravi and his family would be anchoring the fund with a 100 crore contribution to begin with. We already have some soft commitments from several family offices and our investors in the PMS. So we should be having our first close very soon.
Okay. Can you share with us any details of the existing investors?
Now, without naming anybody, I would say some really reputed family offices
Okay.
are.
Now, Ravi, you already invest in the private space. Walk us through what the outlook is in terms of what the returns have been so far and how that's fared.
See, it is pretty well known that today we are in a funding winter, and it is not easy to raise funds. So I would rather that we enter the market in such kind of a scenario where it is not tilted in favor of the seller, but it is tilted in favor of the buyer. So maybe 12, 18 months back, the scenario was completely different where, the promoters and the founders were deciding who will be on their cap table. Today, now they are looking for funds. Even the existing funds are kind of looking to support only few of their portfolio companies, and they are picking and choosing between them. In this kind of a scenario, what tends to happen is that the baby tends to get thrown out with the bath water, and good opportunities tend to arise. And over the next 1 to 2 years, would be a great period to deploy some capital into the private equity space, is what we feel.
Okay, fair enough. So, Varun, walk us through, what the target is. There's going to be late-stage startups that will be looked at very closely as an investment opportunity, I understand?
See, essentially, investing hasn't changed much across decades, whether it be private equity or public market. Ultimately, the basic essence is find the right management team, find a business model, find the right product market. And the rest of the thing is more behavioral with the fund managers, where what valuation you're paying. But the core remains the same. So we are looking for companies where they're beyond the value of debt. They've crossed the chasm, so to say. We will not participate in companies which are burning a lot of cash. We're looking at companies which have reached a certain inflection point. From there, they could really change scale in terms of revenues and their cash flows. So essentially what we're looking for is rate of change and change of rate in industries and companies. So for us, we would wait for companies to reach a certain point, and then we would evaluate whether it really makes sense from us. So as Ravi said, so this fund is an extension of our 20, 30 years of learning in the market.
Yep, sure it is. And that, of course, gives you an edge. And I like the fact that you said rate of change and change of rate. And I just wanted to understand, Varun, from you, what would be a reasonable return expectation or a reasonable holding period in the private space?
Well, our fund is a 5-year fund, and we are working to deliver in close anywhere between 25 to 30% CAGR.
Okay, fair enough. So, Ravi, what's the outlook now on, some of these new age tech companies that have made their debuts on the Lal Street? We've, of course, seen the treatment that they've been meted out with, but now a lot of them seem to be pulling up their socks, if you will. The path to profitability seems to be very clear for a lot of these companies that's been outlined. Do you think that the perception now is changing, or that there was already that underlying positive momentum that wasn't really being recognized by the market?
See, one thing is very clear. The digital economy is here to stay. Digital economy will probably be $1 trillion out of the $5 trillion that we are targeting. The market and the value creation that is going to happen on the digital side cannot be denied. But we tend to go through our cycle of emotions where I think things got a little out of hand on the positive side 12, 18 months back. And now they are on the other extreme where we are actually giving up on these business models. But the truth lies somewhere in between. I think once we are through with this, we will come back to a growth phase, and there is a lot of value to be created over here. And of course, there will be a lot of casualties along the way where the business models cannot sustain. But where the promoters are frugal in terms of burning cash, and it is not only about acquiring customers, but it is also about delivering profits. As you rightly pointed out, it is no more about we have already moved to having every company thinking about path to profitability and getting their unit economics in place. That brings some sanity to the space. Having said that, I think there is still going to be a 12-month period where a lot of pain is going to emerge, and that is the area where we believe we will have some edge from the point of view of timing over the next 5-7 year period.
Yeah, and Ravi, it is interesting because we also recently had HDFC Mutual Fund introducing their first AIF. Do you think now we're likely to see a lot more public market investors adopting this strategy and a lot more interest in the private equity space?
I think for all public market investors who do want to institutionalize, who do want to graduate into going backwards a little bit, I think that this is the next logical step. Most of them are actually taking the Cat 3 route. We have actually chosen to take in the Cat 2 route, where this is actually a much differentiated product. It is a private equity product as against another listed market product, but just packaged as an AIF.
Okay. Varun, wanted to understand from you what kind of investors really should look at investing in the private space. I just want to, get a sense as to what their risk-taking profile would be, or how much percentage of the equity portfolio do you think should be assigned to the private space?
No, you're absolutely right. Private equity is higher up on the risk curve, and there is a lock-in period involved over here. You should be ideally willing to not look at that money for at least 5 years, maybe even 7 years. So your expectations have to be on the lower side in terms of getting your money back sooner. In terms of risk profile, I believe your allocation to the private equity space ideally should not be more than, if you are even if you are a very risk-taking investor, it should not be more than 15-20%. If it is more than that, then I think you have to factor in for the fact that there could be a liquidity crunch. So you have to allocate more towards listed and slightly less towards private equity. And I would not go beyond 20% in terms of overall equity allocation.
Okay, not more than 20%, about 15 to 20%. So, Varun, we were talking to Ravi as well about this with respect to the startup winter that you guys were alluding to, the fact that we are seeing a rising interest rate environment, recessionary fears, a lot of companies that have been laying off employees. Is that not a worry in a climate such as this? And do you believe that it can be extrapolated to the startup ecosystem as a whole, or it's only going to be select companies that will be weeded out on the back of this?
Well, actually, bear markets have always been, better for investors who are looking to deploy capital. In fact, just maybe a year or 2 years back, Ravi and me, we were wondering, even if we raise capital, the markets are really in a frothy zone. What will we do? So today we actually are entering at a perfect time when it's a buyer's market versus a seller's market, maybe 18 months back. It may be hard right now to raise capital from investors, but it certainly would be better to evaluate companies. One, it would have already separated the men from the boys. So today, a lot of companies are probably hanging boots or facing cash crunch. Very few will get capital. Valuations have become much saner. And the markets are already revealing, where the future is, which companies are going to survive, which companies are going to build scale, which management teams are really built for, all weather conditions. So it's a good time for us.
So, Ravi, if I may, is there any sort of a profile of a company or any, companies that should, tick the right pointers that you will actually look out for, or that you've identified that you believe have long-term potential? Any sort of a profile, maybe?
No, so I would like to say that, see, we are sector agnostic, and our focus is more on the stage of the company. We are looking for companies that have crossed that chasm of death, where essentially it is not about unit economics, it is not about profitability, it is about growth capital. Where what tends to happen is because of this funding winter, even some of the good companies are not getting any kind of capital, and that is leading to some good opportunity getting created. There are a lot of IPO failures that have happened. So we are not marrying ourselves to any particular sector. We are looking for companies which are going to scale up in a big way, provided they get the capital in the next 3 to 5 years. So we will focus on the stage of the company, not on the sector. It is not necessarily that it has to be a tech-enabled business only. In fact, some of the opportunities that we have in the pipeline are more brick and mortar kind of opportunities. Yeah, Varun, go ahead. You wanted to add something?
No, you covered it well. So, companies which have, it takes, as they say, 20 years to create overnight success. So we're looking for companies which have worked hard, reach a certain point, let's say $100 million revenue, or maybe some level of EBITDA. And from there, they need growth capital to replicate their success, which is much faster, much easier. All the experimentation and the cash burn is behind.
All right, point taken, and it's pretty interesting. Now look forward to a lot more public market investors entering the private space, and wishing you all the very best with this new AIF, and hope to interact with you a lot more, Ravi, on the markets and on Startup Central. And thank you so much, Ravi and Varun, for joining us.
Thank you so much.
Thank you so much.
Talking with you.
Pleasure talking.